Because doing this too far in the future doesn't make too much sense. 25, 26. I'm going to basically assume that it hasn't moved since March. Upper bound too low. Oh, you need to enter the right price. It is the right price, 95.08. There's something wrong with that price. But again, July volumes, it's not so bad. I don't think this is doing it right, so I'll kind of stop there. But you can figure out from the August number, there is no meeting in August. So if you think about it, 100 minus 95.13, 487. Yeah. Market pretty much says there's going to be 50 basis points move in the next two meetings. After that, the chances are Fed is going to stop. That's going to depend a lot on what sort of inflation and growth numbers we get in the meantime, but that is market's assessments right now. And one of the reasons market has done well the last week and today is market's assessment of Fed moving too fast is going down. This is a beautiful contract. It's a derivative contract. Its value depends upon what happens to something else. That's what a derivative means. I mean, you cannot arbitrage this one, but you can basically take bets. I mean, the way it works, you look at the specs for each contract. Value of 1 basis point is about $41.67. That means the average Fed funds rate moves by 1% and 1%. From each contract, you make or lose, depending upon your direction, $41.67. If you do it for 100 contracts, that's a lot of money. And as far as margin is concerned, you just put in $600 to control one contract. If everybody bets that it's going to be 25, you bet that it's going to be 50, you're going to make 25 times 41.67 per contract times number of contracts. At 100 contracts, that's $100,000. How much money did you put in as collateral? 600 times 100, that's 60 grand. So if you know what you're doing, you can actually make a lot of money in these things, as long as you predict the direction of the market correctly. So there are some people that actually use this to speculate. Sometimes you can also use this to hedge yourself. A lot of brokerage companies give federal funds rates as interest rates to accounts. You know, if you have a floating cash, they give you about federal funds rate. They can typically fund themselves at much higher maturities, relatively speaking, for that month fixed. But there is the risk that Fed funds rate could go up too much during the month. You can use this to hedge yourself. So it's useful for a lot of different things. But it's one of the simplest ones. You could do something similar on 3-month interest rates. It's called Euro-dollar rate. We got 10 minutes, so let's work on that. For those of you who haven't taken international finance, the term euro-dollar has nothing to do with euro. It's an old term that started in the 70s. Euro-dollar meant dollar-denominated deposit that is in a bank that is not in the United States. So if you deposit $1 million to a Japanese bank, but the account is in dollars, that's a euro-dollar account, not, samurai dollar account. That was the term. These days, euro-dollar rates refer to roughly 3 months LIBOR rates. Again, it's 100 minus. So currently, this is as of February, let's see the specs, I think it's the 3rd Wednesday. I always, 3rd Wednesday of the contract month, which is going to be after the Fed meeting, but 95.0675 means about, remember, 100 minus is the reference interest rate, about, let's see, $491 for 3-month rate, and you should look at numbers at the end of each quarter because more of the trading volume is there. So 504 is the expected 3-month interest rate. In March, if you look at June, it's getting lower. September, about the same. December, it's even lower. So market kind of expects short-term interest rates to go down, starting maybe in September or so. Then that's market's expectation. Doesn't mean it's going to happen. But you could use these sort of things to hedge short-term interest rate exposure, which we're going to do later during the semester. Again, controlling each contract, $600. The value of 1 basis point is $25. So if 3-month interest rates are 10 basis points more than what the market thinks, and you bet in the right direction, from each contract you're going to make $250. If you have 100 contracts, you're going to make $250. $25,000. But you're going to put it only 60 grand. Of course, this is for a 20 basis points move. For a 25 basis points move, it's going to be much more. let's stop here today. On Wednesday, I'm gonna get the first half of the class. I'm gonna spend somewhat theoretical to kind of justify something like Black-Scholes for options. The generic approach to finding the prices of any derivative contract, and then we're going to apply it to Black-Scholes. Figure out what options are, what are they useful, how do you read the prices, so on and so forth.